Welcome to the Deep Dive. Today we're getting into the Q1 2025 earnings call from PZU Group, big insurer in Central Europe.
That's right. We've gone through the transcript, the official word from management.
And our mission, as always, is to cut through the corporate speak, get to the important stuff, the key numbers, what the execs are thinking, and what it suggests about where PZU is heading.
Exactly. Taking their own words and figuring out the story behind the results.
Okay, so let's jump right in. The absolute headline grabber from Q1, profitability, it was historic.
It really was. 1.8 billion PLN in profit. That's the best single quarter they've ever reported since going public.
Wow. Okay. And what about the top line, the revenues?
Also up. Insurance revenues hit 7.5 billion TLN. That's about $500 million more than last year.
So growth there too. Good sign.
Yes, though management did kind of hedge that a bit. They seemed happy with the number itself, but maybe felt it wasn't quite keeping pace with the overall market growth. A bit unambitious compared to the competition, maybe.
Interesting nuance. But still, that 1.8 billion profit, that's the big story. They said it beat their own expectations, right?
Yeah, across all four components that make up the profit number, they seemed genuinely pleased, maybe even a little surprised by the strength.
But they also threw some cold water on it, didn't they? About extrapolating.
Oh, absolutely. A big caveat. They made it very clear. You cannot just take this Q1 number and multiply by 4 to get a full year prediction. Q1 isn't usually the strongest quarter anyway.
Right. Context is crucial. And speaking of results, what are they planning to do with all that profit? And you talk about dividends.
Yes, definitely. They've put forward a recommendation to pay out 4.47 PLN per share.
Okay.
Which essentially means they're distributing almost all of the unit's profit, just holding back a small amount for a social fund as Polish law requires.
And a date for that.
Proposed date is October 16th, 2025.
Got it. So record profits, solid dividend plan. How does this leave their financial health, their capital position?
Looking very stable. The group's solvency ratio came in at 226%.
And just quickly, solvency ratio, that's their safety buffer, right? Capital versus risks.
Exactly. How much cushion they have above the minimum required capital. So 226% is a strong number for the group. It's a bit lower than before, mainly due to consolidation effects. But the core insurance unit, PZWS, is even stronger at 240%. Very solid.
Feels like they're on firm footing financially. They even mentioned the stock price, didn't they?
They did. Acknowledged it recently crossed 60 PLN, and the market cap went over 50 billion PLN for the first time. Just noting that the market seems to be responding well lately.
Okay, sets the stage. Record profit. Now, the big question, how? How did they pull off 1.8 billion in Q1?
Right, let's unpack the drivers. There were a few key things really boosting that number.
What stands out?
Well, a big chunk came from the insurance result itself, the core business. That was up by almost $500 million PLN.
Significant.
Very. And then the investment portfolio also kicked in nicely, added nearly 100 million PLN, which they linked to, the current market interest rates being helpful.
Okay, so insurance doing well, investments helping. Anything else?
Yeah, they also mentioned achieving a higher operating margin than they'd planned for, so better efficiency in running the business too.
And this all feeds into that number everyone talks about, the combined ratio. It was low.
Extremely low, 82.5%. Just to remind everyone, that measures claims costs plus expenses against the premiums earned. Under 100% means you're making a profit just from underwriting before investments. 82.5 is, well, exceptional.
Almost too good to be true.
That's exactly what management said. They were very upfront. That level is, and I quote, unsustainable and impossible to maintain in the long run in a competitive market.
Okay, so why was it so low this quarter then? Pure luck.
Luck definitely played a part. They pointed straight to a very favorable weather situation. No big winter storms, no major floods, no tornadoes hitting their books hard.
Quieter catastrophe quarter.
Exactly. And also, no major losses from their big corporate clients happened to hit their retained share this specific quarter. But it wasn't just luck or external factors.
Ah, okay. What else contributed?
They also mentioned improvements in sort of the quality of the business they're writing and better cost efficiency. There was also a technical accounting effect, amortization of losses from prior periods, helping offset current claims payments, and crucially, a pretty significant one-off item.
One-off, like not repeatable.
Correct. estimated around 100 million PLN. It came from releasing excess claims reserve.
Reserves. Money set aside for future claims.
Exactly. For claims that have happened but aren't fully paid, sometimes insurers estimate high, and if the actual payouts end up lower, they can release that excess money back into profits. That happened this quarter, specifically in their corporate portfolio reserves from past years.
Okay, so a perfect storm. In a good way. Quiet weather, no big claims, some internal improvements, plus this reserve release.
That sums it up pretty well. And this massive profit ties directly into the strategy they discuss. They use this phrase, collecting ammunition for further fight.
Collecting ammunition. Sounds like they're preparing for something. What's the idea there?
It signals their priority right now. It seems they're consciously focusing on maximizing profitability and building up their financial strength rather than maybe chasing market share at all costs.
So profit over premium growth for now.
That seems to be the clear message. The thinking is, if they build up this ammunition, this financial firepower now, they'll be in a much stronger position to compete aggressively later against rivals who might be sacrificing their margins today just to grab share.
Building a war chest. Makes sense. Get strong, then fight.
Precisely. It acknowledges that maybe this quarter's amazing profit happened partly because they weren't pushing as hard for growth as some others, allowing them to be more selective, focus on the better margin business.
Okay, let's see how that played out across the different business lines. How did the property segment do?
Property showed stable revenue growth. Management did explain a little nuance there. Sometimes the premium number looks different under Polish accounting standards compared to the international standard, IFRS 17, especially for long-term corporate deals. But the key point was profitability improved across the board. Liability, comprehensive, non-motor property lines all did better.
Good. What about motor? That's always a tough segment.
Still challenging, yes. Looking at the Polish standard numbers they presented, price increases in the compulsory liability insurance OC are kind of losing steam. About 7.6% growth in Q1.
Which isn't keeping up with costs.
Apparently not. And Auto Casco, the comprehensive cover, saw price rises of only about 4%. Management was quite blunt. Neither of those are really generating value right now compared to how fast costs are rising.
So still pressure there.
Definitely. Auto Casco might be technically profitable on its own, but the overall motor segment is dragged down by the liability side, which struggles with profitability. They're trying to recover from big losses last year, but the market is still super competitive on price.
Anyone helping them out? Fewer accidents, maybe.
That was a positive factor, yes. They mentioned favorable accident frequency in Q1, fewer crashes. But the inflation hitting repair costs is still a major headwind when claims do happen.
Right. And they tried to explain the accounting differences again, IFRS 17 versus Polish standards.
They did. Just reiterating that while the quarterly profit recognition can look different under the two systems, MSR, which is IFRS 17, and PSR is the total profit over the life of the policy should end up being the same, MSR is generally seen as more conservative, forcing them to book potential losses up front if a part of the business looks unprofitable long term.
Got it. Okay, moving on. Corporate segment.
That was a strong spot. Continued double-digit growth, especially in non-motor lines. Costs were down, partly helped by that one-off reserve release we talked about.
And profitability.
In the non-communication part, it was exceptionally high, around 50%. But again, they quickly said, look, that's not sustainable. Still, the operating result there was up significantly, about a third year-on-year.
Okay. How about life insurance?
Steady increases in the individual continued group and individual protection areas. Top-line growth came from higher contributions and also releasing some of that contract margin.
Contract margin. That's the expected future profit built into the policies.
Under IFRS 17, yes. Releasing it boosts current profit. They also saw higher expected benefits being paid out, partly due to indexation and just the insured base getting older. Costs were flat, so the operating result looks strong.
And you mentioned mortality rates. Life expectancy trends.
They did touch on it, said the overall mortality rate trend was slightly negative, up about 6% year on year. But interestingly, the mix of claims changed favorably. So while maybe slightly more people passed away relative to the pool, they ended up paying out less per death on average.
Huh. Interesting mix effect. What about the broader individual and protective lines?
Costs there are basically moving in line with revenues. Operating profit saw a decent 10% increase. Management seemed particularly happy with the contract margin growth here. They saw it as proof they're not just selling new policies, but also successfully upselling or adding more cover to existing customers, generating longer-term value.
Good sign for customer retention and value.
Good. Well said.
Lastly, Asset management and the investment portfolio.
Asset management, they highlighted being number one for net inflows among non-bank funds in Poland, bringing in 1 billion PLN in Q1. Good result, but they still sounded like they want more.
Always hungry for more. And the investments themselves.
The investment portfolio contributed positively across the board: interest income, equities, real estate. Real estate got a temporary boost from currency exchange rates as they only value it twice a year. Overall, annualized yield for the portfolio was 6.3%.
Okay, so pulling it all together. Undeniably strong profit for Q1. Mix of good luck, some solid operational gains, that one-off reserve release, and this strategic choice to focus on profit over just chasing premiums right now.
That's a fair summary. But it's clear not every part of the business is firing on all cylinders or growing as fast as they might want.
Right. And there was one segment they really singled out as needing some serious work.
Yes. The health business.
What was the issue there? The growth number wasn't great, was it?
Less than 10%. And management's description was pretty stark. Terribly unambitious.
Wow, terribly unambitious. You don't usually hear that on an earnings call. What's the problem in health?
The core issue is a split personality almost. They want to grow health much faster, but they're insistent it has to be profitable growth.
And the main part isn't profitable right now.
That's the crux of it. They have their own medical facilities, like the Gamma company they bought. Those are making money. But the much bigger part, the insurance and subscription side, generates most of the revenue, but is apparently unprofitable or barely breaking even.
So just growing that part faster would mean growing losses.
Exactly. And management said point blank.
Yeah.
The goal is to make money, not to grind money, chasing unprofitable sales. Fix the model first, then scale.
How are they tackling that?
Well, they highlighted appointing a new president for PZU's Drowie, their health division. Importantly, he also sits on the main PZU management board now. That dual role is meant to signal serious commitment from the top to integrate health better and fix that profitability problem.
Makes sense. A clear signal of intent with that leadership move. Okay, looking beyond Q1, what did they say about the future? Strategy, regulations, group structure.
They mentioned their big strategic revenue target, 36 billion PLN. Acknowledge it's going to be tough to hit at the current growth rate, which ties back to what we discussed. Rebuild profit first, then push hard for the market share needed for that big top-line number.
And the regulatory side, solvency too.
They expect to keep decent solvency ratios, but flagged big changes coming. The move to a holding company structure plus new solvency SEC rules kicking in around 2027 will significantly alter the capital requirement.
Oh, so more capital needed.
Yes, likely a substantial increase, especially because the new rules will properly account for the risks of holding big bank stakes, which the current rules don't fully capture with specific buffers. Other regulatory tweaks might also knock about 5-6% off their solvency ratio.
Sounds like a major hurdle to plan for. How are they preparing?
A key piece is developing their own internal model for calculating capital needs under Solvency II.
Instead of just using the standard formula everyone else uses, why do that?
The standard formula is kind of a one-size-fits-all. An internal model, if regulators approve it, lets them calculate capital based on their specific risks. Management used a good analogy. It's like getting custom-fitted shoes instead of everyone wearing the same size.
So it might better reflect their actual risk profile. Could mean less capital required.
Potentially, yes, if their risk is lower than the standard formula assumes. But maybe more importantly, it helps them align their pricing better with the true risk and the capital needed to back it. The standard formula might force some inefficiency that gets built into prices. Custom fit means better efficiency.
Makes sense. And the holding structure itself, is that definitely happening?
Seems so. They confirmed the plan is to transform into a holding company by the end of 2026. Said they have no other choice, really, given where regulations are going, committed to the timeline.
What about those bank stakes, PKO Bank specifically?
They mentioned their agreement with PFR, the state fund, which clarifies some ownership aspects. But they said the exact structure and level of involvement in both banks they hold stakes in will be a major factor in designing the final holding company. Expect more details on that and recommendations on the bank shares around Q3 this year. And just to clarify on the law for the holding structure, it's not some special Lex PZU. It's apparently a standard update to insurance law, making it work similarly to banking law for dividing up enterprises, common practice in the EU.
Okay, so wrapping up Q1. Exceptional profit, yes, health by luck, some solid execution, a one-off, and this strategic decision to prioritize profitability for now. But management clearly sees challenges needing faster growth overall, fixing health's profitability before scaling it. And big structural and regulatory changes are on the horizon that they're actively working on.
It feels like a moment of shoring up the foundations, using this strong quarter to build strength for what comes next.
Which brings us back to that phrase, collecting ammunition. If they need to eventually ramp up sales significantly to hit those big revenue goals, but right now they're focused on profit, well, it makes you wonder, how long can they keep that specific balance? When does the switch flip back to aggressively chasing growth? And what happens to that carefully rebuilt profitability when they do?
That's the key tension to watch, absolutely. How they navigate that transition will be critical.
Definitely something for us and for you listening to keep an eye on. Thanks for joining us for this deep dive into PZU's Q1 results.
My pleasure.
And just a reminder for everyone, this conversation was for informational purposes only. It should definitely not be taken as financial advice.